Hi everyone, my name is Amir Anik bin Matno. My ID number is MDB2311004. So for this assignment, I will be answering question 1. The question is a low or high inflation rate an absolute indicator of an economy in a good or bad state? The answer is The answer for the question is no. A low or high inflation rate isn't an absolute measure of whether an economy is doing well or badly. Inflation is just one piece of the puzzle, and by itself, it doesn't tell the whole story. For example, even though Malaysia's inflation rate dropped to 1.5% in November 2023, it doesn't automatically mean everything in the economy is perfect. Inflation has to be looked at in context. Take the East Asian financial crisis in 1997. During that time, inflation rates were high, but that didn't mean the economy was healthy. Instead, it was a sign of serious problems with the currency and demand in the region. On the flip side, a low inflation rate like what we are seeing now might look like good news, but it could also point to weak demand. Businesses might be lowering prices because people are spending less, which isn't great for economic growth. The article also points out that inflation has been on a downward trend since August 2022, which is something we haven't seen since 2011. While it might seem like it's a relief, it's important to remember that as long as inflation is positive, prices are still going up. So even if inflation is low, people could still feel like they are paying more for everyday goods. Plus, a consistently low inflation rate can signal that the economy is slowing down, with businesses cutting prices to try and get people to spend more. In the end, you cannot just look at inflation alone. You need to consider other factors like demand, production costs, and how the global economy is doing. Just because inflation is low doesn't mean that living costs are dropping or that the economy is thriving. It's about seeing the bigger picture and understanding how inflation fits into everything else. This graph shows Malaysia's inflation from 2011 to 2023. In 2016, inflation peaked at 4% due to rising fuel prices. In 2020, in 2020, inflation dropped below 0% during the pandemic. In 2021, it spiked again as the economy reopened. In 2023, inflation is trending down currently at 2.1% and projected to hit 1.5% by the end of the year. This shows how inflation is affected by events like fuel price changes and the COVID-19 pandemic.
First, there's a cost push inflation. It's happened occur when production costs such like wages, raw material, raw material rise, leading business to increase the price to maintain profitability. There is a statement in the article at paragraph 4 which is during the East Asian economic crisis of 1997 and 1998, Malaysia experienced a sudden fall in the value of the ringgit and the inflation soared to 5.3% in the 1998. Generally speaking, increased production costs are one of the factors leading to inflation in this episode. This statement proves that there's a cost push inflation happen. Cost push inflation happens where rising production costs, like an increase of the import price, usually due to currency devaluation in this case. The push up the price and then it's push up the price of goods and service. The fall in the value of the ringgit increased the import cost, which raised production costs and lead to the higher inflation, fitting the definition of the cost push inflation. For example, if oil price rise, transportation costs for business will go up. As a result, company might increase the price of goods like food or electronic to maintain their profit margin, leading to a cost push inflation. The second example, what we can tolerate from the real life example, in 2022, Germany experienced a cost push inflation, primarily due to the sharp increase in energy price following the Russian invasion of the Ukraine, which cut off much of the Europe gas supply. Second, there's a disinflation. So what is that? Disinflation refers to a slowing down in the rate of inflation, but at the same time, prices are still increasing, but at a slower pace. The inflation rate for November stands at 1.5%, marking this as the lowest point compared to the same period from the last year, which recorded 4.0% inflation in November 2022. Following a continuous declining trend since August 2022, this statement for the paragraph 1 proves that there is a disinflation. The article implies that the disinflation is occurring, which refers to a reduction in the rate of inflation, where the price are still rise, but at a slower pace. Evidence of a disinflation is noted the inflation rate for November, which stands at 1.5%, a significant drop from 4.0% in November 2022. This decrease indicates that a slower rate of price increase compared to the previous year. Furthermore, the article also mentioned a continuous decline in inflation rate since August 2022, suggesting that inflation has been reducing over time. For 2023, the inflation is expected to range between 2.5% and 3.0%, reflecting a lower trajectory than a previous trajectory, aligning with the concept of disinflation. However, the article raised concern that this low inflation rate may be attributed due to decreased demand, as indicated by the decline in consumer sentiment and business condition. For example, imagine the price of a loaf of bread increased by 4% last year, but this year is only increased by 1.5%. This reflects this inflation because prices are rising more slowly. Another real life example that I can give to you in 2022, the US inflation rate reached over 9%, driven by the high energy and food price. However, by the mid 2023, the inflation dropped to around 3 until 4%. Prices were still rising, but at a slower rate. Next, the third inflation that happened in the article is deflation. Deflation refers to a negative inflation where the overall price level falls, typically due to a significant drop in demand. It is the opposite of inflation and can lead to the economic stagnation. Conversely, during the COVID-19 pandemic crisis in 2020, business closure and movement restriction caused all the sudden drop in demand. The inflation rate fell to a negative level of negative 1.1% in 2020. This statement from paragraph 5 proves why deflation happened. The inflation rate going negative in 2020 reflects a deflation where the overall price level decreased primarily due to the reduced demand during the pandemic. While this may seem beneficial, but it can harm the economy by encouraging consumers to delay spending in anticipation of even lower price, leading to a reduced demand and economic stagnation. Japan's prolonged deflation period served as a cautionary tale, showing how falling price can determine both consumer spending and business investment, deepening the economy of downturn. For the example, from 1995 to 2005, Japan experienced deflation, with price of goods and service decreasing yearly. For the real-life example, we can see how a house price fell dramatically during this period, and consumer delayed spending, hoping for a further price decline, worsening the deflationary of the spiral.
Right. Inflation is a significant concern for any economy as it reduces the purchasing power of consumers and can lead to economic instability. In Malaysia, inflation has been relatively stable with a predicted rate of 2.3% for 2024 as government measures focus on subsidies and fiscal policy. Today, I will be discussing the key policy that are in place to manage inflation and the potential risks that could arise in the near future. Alright, Malaysia approach to inflation control combine both monetary and fiscal policy. The overnight policy rate maintained at 3% help to control borrowing and spending. On the fiscal side, subsidy rationalization, especially for fuel like diesel, is a major measure. By targeting subsidies, the government can save up to 4 billion
annually while still protecting key sectors like agriculture and transportation. In addition, reducing unnecessary government spending has helped reduce overall demand, keeping inflation in check. Despite the government proactive measure, inflation risk for 2024 remain. Firstly, the upcoming salary increase for civil servant could lead to demand pull inflation as higher income boosts consumer spending. Right. Next, potential adjustment to RON 95 fuel subsidies and the volatility in global oil price could result in cost push inflation. Higher fuel price may increase transportation costs, driving up the price of goods and services, while the government's subsidy rationalization effort for being effective further change to subsidies for fuel or electricity could also create inflationary pressure. Alright, lastly, fluctuation in food price and other global factor could further complicate the inflation outlook, requiring colourful monitoring in 2024. Alright, before I end my speech, let's summarize Malaysia economy outlook. Inflation in 2024 is forecasted to rise slightly to 3.2%, primarily due to the government's subsidy rationalization and the increase in the sales and service tax SST to 8%. Despite this challenge, the Malaysian economy has shown resilience, recording 4.8 growth in Q2 2024, driven by a recovery in exports and a strong service sector. Now, however, global factors continue to influence the domestic economy. For instance, change in US Federal Reserve interest rate and fluctuating global commodity price are key external risks. Malaysian Central Bank is closely monitoring this development, aiming to maintain stable inflation and exchange rates. Alright, so in conclusion, while the economic outlook remains stable, Malaysia needs to remain vigilant to manage inflation and sustain growth amid global uncertainties. Alright, that's all for me. We move to the next question, question number 4.
Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul Hakim Aiman bin Abdul Jalil from DBS 3A. Okay, what's question I have is the potential consequence of prolonged reduction of inflation. Okay, let's go start. We have two main points in this situation. Is the first one is low inflation rate, and the second one is the danger of deflation. So let's get started. Okay, we go to the low inflation rate first. Okay, since 2011, which is well before the COVID-19 crisis, there have been 4 episodes of which a continuous decline in inflation rate is to be soon. A word of question though, despite a decrease in the inflation rate, as long as it is positive, the average price level continues to rise. A low inflation rate does not necessarily mean a decrease in the cost of living. So we go the next point. To bring us to question in this low inflation rate of 1.5% good news. In order to answer this, we must evaluate what caused the current episode of low inflation rate before concluding it as a piece of resounding news. Conversely, during the COVID-19 pandemic crisis in 2020, business closures and movement restriction caused a sudden drop in demand. The inflation rate fell to negative level of negative 1.1% in 2020. The inflation rate also dropped to a low of 0.6% in 2009. Specifically, due to construction in global demand following the global financial crisis, in this context, inflation rate decreased due to a marked reduction in demand. So we go to the next point. The last point for low inflation rate is the Malaysia Institute of Economic Research (MIER), which conducts quarterly business condition and consumer sentiment survey. Had this to say, for the second quarter of 2023, MIR reported a decline in the consumer sentiment index and business condition index. Consumer and firm anticipated a bleak economic environment and therefore started to limit their respective spending. Simultaneously, the dampening of the global economy has shrunk and country trade balance from RM 26.7 billion in March 2023 to RM 12.4 billion in November 2023. There is a possibility that low demand is driving the low inflation rate. If this is case, then this is definitely not good news. Okay, we go to the second main point. Let's go to the last main point. Okay, the danger of deflation. In actual fact, an inflation rate that is too low face the possibility of deflation or negative inflation, which is an economic danger zone. For example, the Japanese economy has been trapped in a deflation for an extended period. It's often referred to by economists as something to be avoided at all costs, expectation of a continued downward their spending, leading to reduced demand. At the same time, firms will stop investing and further contribute to a prolonged economy. Okay, we done to my answer. Okay, that is clear. Okay, so when it is clear, thank you for you guys for watching me, and I hope that we have to know what means deflation and low inflation rate. Okay, so thank you so much. Bye bye.